Many retailers are struggling to stay afloat as the COVID pandemic continues to impact their businesses. In this video, we're going to explore some of the factors contributing to the closures and discuss the impact on consumers and the broader economy. Stay tuned to learn more about the challenges facing retailers in these unprecedented times. The COVID-19 pandemic has significantly impacted the retail industry, resulting in the closure of numerous stores. This trend has a significant effect on the economy and consumers. In this video, we're going to examine the causes of this trend and consider what the future may hold for retailers as they adapt to these changes in the retail landscape. The retail industry in the Western world has been facing challenges for over a decade. This crisis was exacerbated by the rapid expansion of stores in the 2000s, which led to high rents in city centers and ultimately contributed to the financial crisis of 2008. Many retailers, including Woolworths, were forced to close their doors as a result. Following the challenges faced by the retail industry, consumer behavior changed. Consumers became more price-conscious and focused on finding value in their purchases. Even affluent individuals began prioritizing finding deals and sought out affordable options like Aldi and Primark. In an effort to improve profitability, many retailers reduced staffing and other costs and closed stores in smaller towns and less affluent neighborhoods. In addition to the issue caused by overexpansion, high operating costs, and competition from online sellers, retailers also faced challenges as they lost a share of consumer spending to leisure activities such as dining out, short vacations, gym memberships, streaming subscriptions, foreign travel, and spa and health treatments. While foreign tourists visited the UK in the 2010s, their spending did not come close to what UK residents spent on overseas holidays. In 2014, we published a report titled Retail Futures 2018, in which we predicted that the increasing popularity of online retail and shifts in consumer demand would result in 1 in 5 UK stores closing within the next 5 years. As it turned out, it took approximately 5.5 years for this to occur. The UK has seen the fastest growth in online retail compared to any other country. In 2006, online sales made up 6.6% of the retail market. This increased to 12.7% in 2013 and 19.2% in 2019. This growth in the online market largely came at an expense of physical stores, which lost 12.6% of their market share between 2006 and 2019. The COVID-19 pandemic further contributed to the shift towards online shopping as many stores were closed or had limited capacity. By the end of 2021, online sales made up 26.5% of the UK retail market, although this number has slightly decreased since then. By the late 2010s, most physical stores had also established online presence, allowing customers to purchase items online or by phone for in-store pickup or delivery. The online operations of the John Lewis Partnership, now known as John Lewis & Partners, accounted for more than half the company's business by 2021. Even this employee-owned business has had to close some of its stores. The COVID-19 pandemic has exacerbated pre-existing shifts in shopping behavior. In many countries, including the UK, households were instructed to work from home. Non-essential shops were closed for extended periods, and shopping in remaining stores was made difficult due to hygiene and social distancing measures. The closure or restrictions on hospitality businesses such as pubs, coffee shops, and restaurants also made it difficult to make a day out of shopping. Working from home also meant the employees could no longer make quick purchases at nearby stores or shops while commuting to and from work. In 2020, total sales on London's Oxford Street fell from the usual $10 billion per year to $2 billion. The situation was already dire, but each country's focus on official death and infection statistics, the constantly shifting COVID regulations, and the frequent calls for stricter lockdowns only added to the anxiety and fear that many people experienced. For people, even the simple act of walking past someone on the street or going to a store felt like a risk of death. The COVID pandemic and related government actions have had a devastating impact on the retail sector. And even as the pandemic wanes, it is likely that certain parts of the sector will continue to be disadvantaged due to a lack of returning consumers. As a result, foot traffic in high streets in 2022 is expected to be 10 to 15% lower than in 2019, the last full year before pandemic. It is possible that foot traffic may never fully recover to pre-pandemic levels. Here are some examples of companies that have filed for bankruptcy due to recent declines in the retail industry. ABC Carpet & Home, a retailer of high-end home goods, filed for Chapter 11 bankruptcy with approximately $80 million in unsecured debt and $8 million in secured debt after being in business for 124 years. While the company was initially able to weather the start of the pandemic, it eventually suffered from decreased food traffic and supply chain disruptions, like many other retailers. The pandemic added to existing challenges for the company, such as delays in the construction of its flagship store and difficulties in establishing a strong online presence. At the time of the bankruptcy filing in 2021, sales had declined 50% from 2018, totaling just $25 million. The company announced that it would continue regular operations and seek a buyer through an auction by the end of October. Lorna Jane, an Australian activewear retailer, filed for Chapter 11 bankruptcy in California after its brick-and-mortar sales dropped 56% in 2020, leaving it unable to meet its lease obligations. Despite experiencing an increase in e-commerce revenue during the pandemic, the company was hit with a $3.7 million fine in July 2021 for falsely advertising that its clothing could eliminate and protect against COVID-19. The bankruptcy filing was intended to allow the retailer to cancel its 21 U.S. store leases while continuing to sell to U.S. consumers online. In August 2021, Sequential Brands Group, a consumer brand owner that owns brands such as Jessica Simpson, Joe Jeans, Avia, and One, filed for Chapter 11 bankruptcy protection. The company ended 2020 with a debt of over $450 million, which it had been struggling to pay down amid executive departures. Despite selling off large assets such as Ellen Tracy and Caribbean Joe in an effort to improve its financial standing, the company was unable to recover and filed for bankruptcy just 3 weeks later. Upon filing, it sought to sell most of all of its assets and initiate a bidding process for interested buyers. In July 2021, Global Brands Group USA, the North American's arm of apparel maker and brand owner Global Brands, filed for Chapter 11 bankruptcy. The company, which was established in 2005 by Li and Feng and licensed brands such as All Saints, Saga, and La Tigra, and also produces private label products, generates around 85% of its sales through wholesaling to retailers such as Macy's, Nordstrom, Bloomingdale's, and Costco. The decline in retail store foot traffic and consumer spending caused by the pandemic, along with supply chain disruptions, liquidity issues, and pressing royalty obligations, led to a 44% drop in sales in the fiscal year ending March 2021. GBA USA entered into purchase agreements for its Aquitalia brand and others and sought to sell its remaining assets under court supervision. In June 2021, mall owner Washington Prime Group filed for Chapter 11 bankruptcy protection after temporarily closing around 100 shopping centers. Many businesses were unable to pay rent due to the financial strain of the pandemic, leading to a drop of $127 million in the company's rental income in 2020. The decline continued from March 2020 to March 2021, with income falling from $10 million to $3.3 million. As part of the bankruptcy proceedings, WPG entered into a restructuring agreement with its creditors and secured $100 million in debtor-in-possession financing to maintain business operations while working to reduce its debt by $950 million. We have seen a significant number of retailers filing for bankruptcy or closing their doors permanently. This disruption caused by store shutdowns, decreased foot traffic, and supply chain disruptions have been devastating for many companies. And it's clear that the industry will not be returning to business as usual anytime soon. It remains to be seen how the retail sector will recover from these challenges, but it's clear that the companies that are able to adapt and innovate will be the ones that emerge on the other side. Thanks for watching. We'll see you in the next one.